A special welcome to our partner, the World Bank, through the Public-Private Infrastructure Advisory Facility, the Global Infrastructure Hub, PIAF GIH in short. We have colleagues joining us from Washington, D.C., and I know that it's still morning for them, and we are truly grateful that you could join us and give your 67 minutes plus of service on this Mandela Day. We have been partnering with PIAF, the Global Infrastructure Hub, on our G20 presidency this year to advance infrastructure priorities, specifically on what we call Priority 1, which is about developing an investable infrastructure pipeline that can attract significant private sector participation. The priority seeks to develop a framework that will offer guidance for creating a robust, investable and transparent pipeline of infrastructure projects by emphasizing critical cross-cutting enablers and their implementation throughout the asset lifecycle. And in the context of a significant infrastructure financing gap and constrained fiscal environment in emerging markets and developing countries, including in South Africa, it is critical that we mobilize private sector financing and expertise to support our economic growth and development objectives, to foster social inclusion, as well as progress towards the achievement of sustainable development goals. And in our effort to mobilize significant private sector capital for public infrastructure, data, of course, has emerged as a game changer. Data is vital throughout the infrastructure project life cycle, supporting the distinct needs of investors on the one hand, governments, as well as regulators. And this webinar will highlight the latest trends in private sector investment in infrastructure across both emerging and advanced economies to foster a deeper understanding of emerging patterns, the trends, the risks, and the opportunities, thereby supporting informed and evidence-based infrastructure planning and investment decision-making, while facilitating effective partnerships with the private sector. The trends that will be presented have informed what we call the G20 Note on improving the accessibility and availability of key market data that has been compiled by PIAF, the Global Infrastructure Hub, to support governments in enhancing the availability and accessibility of high-quality data, of course, as I said, to attract substantial private sector investment in public infrastructure. And the report will be made available publicly on the G20 website after it has been endorsed by the finance ministers and central bank governors, who are meeting right here where I am in Zimbabwe, KZN. And the trends, which is today's presentation, will be delivered by Henri Blas and will be followed by a Q&A segment. He will take about 20 to 30 minutes just going through the trends, and the idea is that we have a lot of time to deal with question and answers and whatever else inputs that colleagues would like to make. I just want to make the point that Henri has an illustrious resume, and it will take too long to read. So I want to summarize it, and I hope I do a good enough job. Henri is currently the Global Infrastructure Hub Program Lead at the World Bank, working under PIAF. He leads efforts to leverage the knowledge and data of the World Bank and its partners to advance sustainable, low-carbon, resilient, and inclusive infrastructure investment. He has over 20 years of experience in infrastructure policy, in economics and finance, project preparation, and resilience. Before joining the World Bank, he was the Chief Content Officer at the Global Infrastructure Hub, the G20's dedicated infrastructure body, where he oversaw strategy and knowledge products aligned with G20 priorities. He continues to support the G20's infrastructure agenda through his current role. Earlier in his career, I believe Henri served as a resilient finance lead, as well as the COO at the Global Resilient Cities Network, working with over 100 cities on urban resilience solutions. He also developed AECOM's infrastructure advisory practice in Asia and worked on asset evaluations and M&A transactions at Macquarie Capital. Henri, let me hand over to you to take us through the presentation. Thank you very much.
Thank you, Botimolo, and the whole GTAC team for organizing the webinar today. And to everybody else joining, thank you for being here on a Friday. Really looking forward to the discussion we'll have after the presentation. So today I'm gonna share some of the major trends that shape private investment infrastructure. The objective really is to offer hopefully a fresh perspective on the global trends we're observing. So here we really covering both developed and emerging markets together. But more importantly, to hear from you as well after the presentation, practitioners working across Africa about what you're seeing on the ground and where we might collaborate on future research. So the session was meant to be informal and interactive, and so towards the end, I really like I say, look forward to for you to ask any question or raise any clarification or share your own experience or reflections in response to the trends that we're going to see. So before I dive in, I'm going to put the link to the monitor report, the latest one that will contain more details. So obviously here during the presentation, I'm going to be fairly high level, but you can find a lot of the more detailed trends on that document. And then before I dive in, I guess just two quick caveats, I guess. First, and I think that was one of the part of the work that we've done with Botimolo and team for the G20. There are still significant data gaps. So what we're seeing is the best data we could find. I'm here not saying that this is the absolute reality on the ground. That's especially the case in emerging markets, and probably even more so in Africa. So that's why your insights actually are very valuable, so that we can together bring us closer to the truth, I guess, on what's happening on the ground. The second is while we've made efforts throughout the presentation to highlight some trends that are more specific to Africa, like I said, the data is limited. And my own experience on the continent is also limited compared to other regions where we're more. So I'm happy to address questions if they're related to the data. But if you have any other more country specific or something more specific to the continent, I'll be happy to connect you with my World Bank colleagues, and many of them have extensive experience. They'd be better positioned to respond to questions around markets in Africa, but also some of the key programs that the bank is currently leading. So with that, let me get started and share the presentation with everyone. Do let me know if it doesn't work. Hopefully we tried yesterday. That was all good. Still loading. Okay, all right. Can everyone see the presentation?
Yes,
yes, it shows.
Perfect. Okay, all right. So I'm not going to go through, I guess, the objective again. I think the one on the source of data, I wanted to thank, I guess, here all the partners. The idea behind the monitor report and the work and the presentation I'm going to show now is that it's built on many partners. So here you've got about 10 to 15. So we work with them provide unique data set that are very specific to infrastructure. So I'm going to organize it around three pillars. First, the factors that impact infrastructure investment. Second, the trends that we're seeing, and third, a little bit of a deep dive on factors that enable investment in ENBs. So let's get started. First of all, the key factors. So I'm going to talk about delivery challenges, then geopolitical landscape and the impact, but then talk about how infrastructure actually, despite all this, has sort of been, it continues to be very, very resilient. And that's something that obviously matters a lot for private investors. So if we look at delivery issues, about a year ago, what we had seen is that infrastructure costs had sort of increased way faster than CPI, which was at the time unprecedented. If you look at the graph on the left, in general, over time, infrastructure seemed to be like the construction index for infrastructure. We're very, very closely tracking inflation, and that was not the case. So we still see probably a differential about sort of 10 to 15%, depending on markets. Some markets are much higher than that. So that remains obviously a challenge in terms of sort of delivery of the same infrastructure. The cost has sort of increased significantly, and while it's sort of like, slow down a little bit, it's still much higher than it used to be. When we look at the construction firms' challenges, clearly shortage of materials was very critical post-COVID. A lot of issues around sort of supply chain. Those issues seem to have sort of gone down a little bit, but there remains sort of challenges around sort of finding labor to actually deliver the infrastructure. If we look at it in a bit more detail, and here try and sort of use some data that we've gathered for Africa versus other countries. This is RIGS data. They have sentiment data for about 6 countries in Africa. Where we see is that the skill shortages continue actually accelerating in Africa. It continues to be like a challenge when it comes to construction firms. The cost of materials, I say globally, the concerns have gone down. That doesn't seem to be so much the case in Africa. That seems to remain, I guess, a challenge there. So those are kind of like important factors, obviously, when we look at the cost of delivering infrastructure, and also the time it takes to actually deliver it on the ground. So that's on the construction side. Now, if we look at the investors, what is sort of the sentiment? Unfortunately, we don't have it by continent. We don't have enough data when it comes to Africa in particular. Clearly, the interest rates and so geopolitical landscape are still sort of top challenges or top concerns, I guess, for investors. What we see, so that's on the sentiment side. If we look at the cost of capital, there's been sort of significant increase linked to interest rate increase as well. So you can see on the sort of right-hand side that the cost of debt has sort of increased quite a bit. In terms of overall increase compared to before, in fact, in emerging markets, it was always sort of a bit higher than in developed markets. So actually the shock has been probably a little bit higher for high income countries that got used to very sort of affordable debt. That's less so the case. So obviously those tensions are sort of coming down a little bit, but it's still much higher. If you do the cost of debt is still much higher, and that impacts investor appetite and cost of capital. So what's the impact on fundraising? So here we have data on how much funds has been raised for infrastructure specific funds. And here we can see the dramatic impact that interest rates and I guess all the challenges have had on appetite. So basically most investors that will normally sort of put capital into those funds have been a little bit cautious. And so we had in 2023 and fortunately continuing 2024, like an unprecedented basically crash in terms of fundraising. So that means there's still a lot of what we call dry powder. So it's not like there's no money to be invested in projects. But basically that's a concern because that dry powder is sort of reducing over time. And so we're seeing some recovery, I guess, in 2025, but we're still sort of far away from where we were before. So just something to keep in mind that this for the fund managers, replenishing those funds is not as easy, I guess. It was never easy, but there was not as simple as it used to be. So something to keep in mind. Obviously, they're sort of a little bit more careful about investing that capital, knowing that replenishing it will be harder. Sorry, I'm seeing a question around someone that can't see the presentation. Is that the case, or was it just one person? Just looking at the chat.
I can certainly see Now I can see the presentation. Please continue.
Okay.
We'll respond to Landiwe.
Okay, great. So that's basically on the investor side. Now, if we look at it from a performance and very high level, if we look at what's driving private investor by type of asset class, when it comes to infrastructure, diversification is usually what comes first, and basically it's a reliable income stream. So why is that? If we look on the right hand side at I guess default rates, which is basically the risk from an investor perspective, infrastructure has always been and continue to be, despite all the challenges that I've mentioned, a very resilient asset class. So regardless of the crisis, the default rates remain very low, and that's also the case in emerging markets. So if you compare that to sort of non-infrastructure loans in particular, in terms of default rates and in terms of recovery rates, the performance is much higher. Hence, that's why investors will continue to sort of pour money into infrastructure as a way to diversify the portfolio, so that they don't have only high risk type of investment. All right, if we look at those default rates a little bit more in detail, and this year we've done quite a bit of work with the G20 and the database that's called GEMS, which is basically a database of all the MDBs sort of sharing their default rates. Here we're not using that data; we're actually using Moody's data, so that we have a overarching view across all the sort of global regions. What we see is that, like I said, default rates are pretty low in general. There's obviously some exception. Among that, Africa actually has one of the lowest when it comes to infrastructure again, sort of default rates among sort of private investment. One of the key reasons is that many of the projects have strong GFI support, guarantees, and so that basically sort of dampen a little bit that risk. But still something that is great, and a story that we try to basically, we're trying to make sure that all investors are aware of this, so that the perception sometimes that emerging markets in Africa can be very risky markets is actually not backed up by that data. Okay, so that was very quick overview on some of those very high-level sort of factors. Now, if we look at investment trend, I'm going to talk about sort of greenfield investment, what we call primary market type of transactions, and that's typically new infrastructure or privatization. Then we're going to look into some of the subsectors, and then some of the aspects that are relevant. More relevant for emerging markets, in particular, so local currency, but also the capital market. So let me start on the overall volumes. So here, what we capture is usually sort of a relatively large PPP type of transaction. If we look at this, and here's primary market, so I'm not talking about acquisition or refinancing, which we call secondary market. So in primary market, we've seen is a clear recovery when it comes to after COVID globally. Right, so that's good. Now, obviously, we have to keep in mind that those are nominal value. If you remember, one of the first slides was around the cost of delivery, right? So the cost of delivery has gone faster than inflation, and inflation itself was already going pretty fast. So yes, it's an increase, but I think we just have to keep in mind that if you were trying to sort of do in real term, that increase is more subdued, right? Still, it's good news. As you can see before that, those type of projects have been sort of pretty stagnant, and 2024 seemed to be on the same track. On the other hand, what we're seeing is that, unfortunately, the gaps has been sort of widening between high-income countries and EMDs. So as a percentage of all investments, the percentage of EMDs continue to go down, despite the fact that obviously those are the regions where the needs are actually sort of the highest. If we look at it from a region perspective, you can see that Africa continues to be a fairly small part of the entire sort of private investment landscape. That compared to some of the sort of key markets like North America, Europe, and Asia in particular. Now, if we compare that to the GDP of this country, you can see that also Africa tends to be on sort of lower end of private capital mobilization. The Middle East and Latin America are sort of better, I guess, at capturing private investment. So yeah, I want to be clear, this is private investment only. I'm not talking about the entire investment in infrastructure, which is obviously significantly higher. And also that it is only sort of those sort of PPP type of structure. There's obviously corporate investment on the private side. It's harder to capture, but still, if you compare it on sort of like-for-like basis, obviously there's still challenges in Africa to attract private investment. Now, if we start looking at some of the more positive trends, I guess the first one is that yes, you know, like I said, the trend is not super positive. At the same time, what we've seen, if you look at one of the key markets, which is energy, is that the price of delivering the same capacity has actually gone down. So in particular, solar, the price has sort of crashed, and it's a huge part of the investment. So you know, actually for the same amount of money nowadays, you can actually increase more. You can actually get more capacity. What we've seen is that renewables have sort of taken over. Almost like the entirety of private investment has been in sort of green energy when it comes to the energy investment, and we're also seeing that when it comes to the use of green bonds and sustainability bonds. So definitely that remains among investors sort of a key area for investments. Huge appetite from investors to again diversify their portfolio to sort of make it more in line with the transition. So now that was primary investment. If we move to what we call secondary market, which is basically refinancing, acquisition, that gives us a feel for the appetite of investors overall. Obviously, greenfield investors and you know, investors more interested in acquisition are slightly different. Secondary market will tend to attract more the sort of pension funds, long-term capital. When greenfield, obviously, that's you need to sort of, you know, shape up projects. Here, what we see is that despite everything, there's a continued appetite to basically invest in infrastructure, especially in existing assets. So that demonstrates that again, investors are still very keen on infrastructure because, you know, diversify their portfolio, because it's resilient, etc. We did see obviously in 2023 a huge significant decrease in refinancing, but that was linked to the interest rates not being really great for investors to refinance. So I think there's been a bit of a delay in sort of relooking at that. One other interesting trend is that if you look at project finance versus corporate finance, at least for the data that we can get, emerging markets have sort of caught up a little bit with developed markets. Developed market, actually, the majority is corporate finance, and we see that slowly, actually, emerging market has sort of caught up to that. All right, so that's now I've covered the sort of very high level trend. If we start looking into sectors, so like I said, renewables sort of increase very significantly across prime market, but also secondary markets. We've seen a lot of activity on digital side, especially on secondary market, a lot of acquisition, refinancing, etc. Transport remains sort of pretty stable. So that's kind of like you know, the overarching trend. Energy storage and renewables, sort of a key area of interest, plus digital, and then the rest has been pretty much sort of stable across the globe. If we look a little bit more closely at Africa in terms of private investments, what we see is actually there's even more around those trends. So talking about renewables and digital, it's actually higher if you look at Africa versus the other EMB's countries. So in a way, the continent is sort of you know, tracking, I guess, closely the other emerging markets, but probably even more so when it comes to those sort of new sectors. The other sort of growth leading subsectors, so I wanted to highlight them. So if we look at it on the left hand side is basically the global view, and here what we're seeing is that hydrogen, e-vehicles, generation with storage in particular, so batteries and data centers have sort of increased quite significantly, both in primary and secondary markets. And when we look at EMDs and greenfield project, we're also seeing the same trend. So those are Definitely subsectors that are very promising, and so we've obviously sort of continued to sort of track them. I think hydrogen, it was really 2023 hype. I think for those that sort of follow the sector, obviously things have slowed down quite significantly recently. All right, so that's investments. So we also look at whether on the construction side, whether that's also in line with what construction companies that are involved in infrastructure are sort of looking at. And here you can see somehow the same trends. Obviously, a bit of a drop of activity during COVID and a clear recovery after that. It then depends a little bit on sector. I think digital as investment sort of trends have shown and continues to be pretty strong, and obviously will continue to be very strong even during COVID years. I think we're seeing some, I guess, worrying trend when it comes to water and waste. And energy continues to be pretty high, especially in high-income countries. So that's one of the trends that explain also the split in terms of trajectory between high-income and emerging markets. There's been a lot of subsidies, at least until recently, in high-income countries when it comes to the energy transition, and that basically has sort of created a lot of opportunities for investors, which in turn have basically sort of distracted them a little bit from emerging markets. We'll have to see how that trend sort of continues or not. But as you can see here, clearly energy in high-income countries was a huge part of the activity of firms involved in infrastructure. What we see in Africa actually is that the overall sort of positive trends are sort of slowing down a little bit, still very positive, but kind of slowing down. Africa still remains a little bit higher, so there's still a lot of activity. And when we look at the sentiment for the next 12 months, I haven't put the graph here, but that's very similar. We're still seeing kind of positive, but unsure of the sort of future trajectory of investment and construction activity. So now we're going to look a little bit at some of the aspects, so like I said, capital market and local currency in EMDs in particular. So what we see is that obviously local currency, is always kind of preferable, obviously. And what we see is that what we call the top 6 markets in emerging markets, China, India, Mexico, Brazil, etc. They're not as the investment is not using as much local currency as developed market, but very close. So those are markets that really managed over time to shift from only relying on sort of hard currency to actually being able to use their own currency. What we're seeing for the other markets is that it's less the case. Obviously, foreign currency is still pretty high, and I'll go back to that when it comes to Africa. But so there's obviously a lesson learned there. Obviously, bigger market, it's a little bit easier to get the market liquid. But that's a positive trend in a way that shows that at least those large markets have managed to sort of evolve. We have a little bit the same story when it comes to the use of capital markets. Obviously, there's something that's way more common in high-income countries, as you can see on the right-hand side. But what we've seen is that those top 6 markets have slowly sort of managed to sort of catch up to a certain extent. So there's more use of capital markets, which obviously sort of bring more liquidity into infrastructure, and also sustainability or green bonds usage has sort of gone down. Unfortunately, as we go to the other markets, it's less so, and when it comes to Africa, even less so. That being said, that shows that there's huge potential to basically sort of continue to invest to create those markets, so that you can then benefit from additional sort of pool of investors when it comes to infrastructure projects. So again, doing a little bit of a deep dive when it comes to Africa. Unfortunately, at least for the project that we were tracking, actually the vast majority of them still relying on sort of foreign currency, hard currency. One of the reasons also is because many of them actually, many of those projects required to be developed in partnership with MDBs. As you can see, MDBs, project with MDBs represents 40%, and overall, if you include SOEs and blended, you probably get to almost 2/3 of the project actually requires some form of DFI support. Okay, so that was the view on overall investment. So now the third part is trying to sort of look at some of the factors that could enable more investment in EMDs. So first of all, I've just talked about DFI and MDBs. I think in general, what we've seen is that renewed interest from all EMDBs, in particular the World Bank, but not only, in sort of supporting infrastructure investment. In fact, when we look at infrastructure private capital mobilization by DFI, we can see a very sort of positive trend, both in terms of what we call indirect mobilization, which is when we do sort of co-financing, and direct mobilization through guarantee and direct advisory.
I'm trying
support.
to connect.
So that's very positive, and we see that across the board. In fact, the World Bank, if you're looking at the numbers, they've actually sort of doubled in recent years, and the bank is obviously very much focused to continue that trend. So if we look at the factors besides the support that MDB can bring, it's very critical, obviously, the enabling environment, right? I mean, it's one of the key reasons why investors can be reluctant to enter emerging markets is the feeling that the regulatory environment is not conducive to private investment. So we have a great tool here that sort of covers about sort of 150 countries, and sort of we've looked at the ratings. I guess we're sort of looking at the strength of that regulatory environment. And what we've seen by comparing all those countries and the actual investments is that on average, each reform that is passed, we see the huge disparity, but on average, can sort of increase investment by sort of almost like $500 million. So that's basically when we look at historically at all the reform that have been passed by countries, in emerging countries, and the impact on private investment. So clearly that remains one of the key efforts required to basically bring more private capital into infrastructure. Among the countries, Africa in general is sort of lower than other countries, but not for some of them, like contract management is actually not so far from the average in emerging markets. But still a lot of effort, and PPIAF obviously is doing a lot of work on that in South Africa and elsewhere to make sure that enabling environment is better and better, so that we get more private investments into infrastructure. So that's on the enabling environment. If we go down a little bit, and one of the key aspects is PPP units or project development funds. So most of the countries have now PPP units, but obviously those PPP units need some ability to support projects, and that's what we call project development funds. And what we've seen is very clearly across all the income levels, including high income countries, is that countries that do have a project development fund in place actually do tend to have significantly higher private investment in infrastructure. Sounds logical, but I think that's something to recognize, is that in order to get the private investors to come in, especially for complex projects, there needs to be some support in order to create the pipeline of those bankable projects. And that's, as Botemulo sort of said, that's priority one of South Africa G20 this year, is sort of make sure that we end up with that sort of bankable pipeline. So that's the work that PPIAF or sort of other like GIF are doing. But that again requires some what we've called project development funds here, and the impact is quite clear. So I'm just going to come back very briefly on the role of MDBs and DFI. What we see is on average, what we get is when we get blended finance, we get a 1-for-1. So basically, $1 of sort of support from DFI pretty much gives you $1 of sort of private investment. There's obviously a huge variety depending on the type of projects, but that's something that's roughly, I guess, the numbers that we're getting. We're getting between 0.5 5 and 1 in general. When we look at the players, what we see is that in Africa, as I mentioned earlier, there's much larger support of NDB, DFI, ECAs, and SOEs in order to get investment from the private sector side. Going a little bit sort of deeper into blended finance and what we see as sort of the most successful way of sort of using blended finance in general. So this is a partnership with Convergence. We're sort of like putting together those blended finance deals. So again, the sample size is limited. It's kind of difficult to get the data on all those sort of all those projects. But in general, what we see is that there's a strong focus on projects using blended finance for projects. So that's why that's the highest one. That's not necessarily the where we get actually the most private investment for the same amount of DFI. In general, what we see according to that to the data, again, you can see the sample size is not massive. But what we see is that when you actually use it on bonds or corporates or facilitated funds, you tend to get more private sector for the same amount of DFI. So I think that's where programs, funds, facilities are something that the bank and other NDBs are trying to develop further, because again, that's the best way to sort of leverage DFI capital. Across the sector, we're seeing some differences. So in general, I guess the larger projects like transport, etc., tend to get slightly higher multiplier. But again, there's a huge variation between projects. Okay, so staying on the topic of blended, I think what we've seen, one of the key things that the World Bank and others are trying to sort of scale up is the use of guarantees. Data on guarantees is quite difficult to get. If it's MIGA, we get really good data. When it comes to private sector that can provide some insurance products, it's actually much harder. But for the deals for which we have that data, it's pretty clear that guarantees can help leverage a lot more commercial debt. So we see the deals that actually have guarantees do tend to have a much higher percentage of commercial debt, as that's on the left-hand side, and also they do tend to sort of deal size tend to be bigger as well. So again, I think that's something that the entire World Bank group is working on, is trying to sort of leverage as best as possible the use of those de-risking instruments in general. All right, so I'm going to finish on this. Hopefully that gives you an overarching view of some of the key trends. A few of the key set of data resources that we've used for this presentation. So I've shared the link to the full Monitor Report 2024. So it gives you this by region, sectors, across volumes, fundraising, cost of capital, performance, ESG even. If you want sort of more detailed country level data, we get two other resources that are very valuable. First is what we call the benchmarking infrastructure development, and it gives basically an assessment and also link to reforms that have been passed by more than 100 countries. Get about 100 indicators for each of those countries, and that covers everything all the way to unsolicited proposals, etc. So very useful tool for policymakers and try to understand what can be done to accelerate private investment in infrastructure through a sort of regulatory and policy aspect. The third one, which is our historical PPI database, and that gives you across emerging markets very detailed information on deals in those markets, including the demand for each investors, support of DFIs, and that's freely available for the past 20 plus years. So hopefully with those, I think that sort of gives you additional sort of data points if you need to. So I'll stop here and happy to take questions.
Thanks, Henri. That was comprehensive and very helpful, extremely helpful. I want to give colleagues an opportunity to ask their questions of clarity or to make their inputs. As we usually do, colleagues, in this in these webinars, please use the raise hand function. We'll give you an opportunity to make your contributions. I don't see hands. Maybe while people are thinking, let me just make a few remarks. I mean, that trends. Oh, there are two hands. I'll finish making my point, then I'll come to the two hands. The trends for me are quite interesting, and it doesn't look like there's a clear overall trend where we can say either things are improving, they're deteriorating, or they are staying more or less the same. And I think it might be a function of the region where you find yourselves. So in some instances, things are improving, in others, not so much, and so on and so forth. And I think that is quite telling to say that while we are looking at global trends, regional trends, and so on and so forth, the point is that it depends on where you are. And that's just a comment on the mixed observations that we see. I think one of the things, Henri, that you can help us with is to maybe just your definition of what private investment is. In our context, there's sometimes a view that private investment means a PPP, which is not the case in South Africa. But I do think that perhaps a definition of what you use as private investment might be helpful. Then I've got my own questions. So let me stop here after making my general point and asking a question, and take Jill and Lerato. Can I ask that you please identify as, oh, hello, Jill. I see you. Please introduce yourself. I know you, but please introduce yourself and ask your question or make your contribution.
Thank you, Boitumelo, and thank you, Henri. I'm Jill Rain from ASISA. So I have two questions. The first is I'm trying to balance the low default rates that are reported by the rating agencies with the pervasive requests for guarantees. Are the default rates low because of guarantees? It doesn't seem to gel. And the second point, which came out of the discussions that took place on the infrastructure work group for G20 recently, was that the risk weights that are used in Basel III are higher. They're higher than for corporate exposure, which might explain why there's been a shift away from project finance to corporate finance. So I was just wondering if you had any views on either of those two matters. Thank you.
Thanks, Jill. Lerato?
Hi, thank you, Henri. My question is around green hydrogen.
Sorry, Lerato, you have not identified yourself.
Oh, sorry. Hi, yes, Lerato Manaisa from Kapow in GTAC. I'm just curious about where we're seeing the most green hydrogen investments, and if there are any investments emerging on the continent. Thank you.
Thanks, Lerato. Henri, I'll also take Nshalati, and I'll give you an opportunity to respond while we take the second round of inputs. Nshalati?
Yeah, thank you so much, Boitumelo. Also, thank you to you, Henri. My name is Nshalati Baloy. I'm with Infrastructure South Africa. So my question actually picks up from Jill's question with regards to, I think it was slide 28, where you spoke about the guarantees. Are you seeing the guarantees predominantly provided by is it MIGA or is it Ministry of Finance? And also if there's any, there was no mention of export credit agencies, because I know they provide guarantees for infrastructure and insurance. Thank you.
All right, Henri, please take it. Colleagues, if there are additional points that you want to make, you can raise your hand while Henri is responding. Over to you.
Thank you, everyone, for the questions. I'll try to take them probably in order because they're quite different. So, but to your points, there's indeed sort of difference across region, difference across sectors. So it's I think overall, in general, we see continued, appetite from global investors into infrastructure. That appetite obviously is sort of focusing on, risk return, right? And so what we've seen is that obviously in developed market, like I said, there's been a lot of subsidy and support for green energy project in particular. So that sort of tend to attract investors. But there's, I think, there's generally an appetite for the asset class and still appetite for emerging markets. So that's why there's like different trends. Now, in terms of the data we can capture is not necessarily PPP per se. I think they are usually in the data that we can capture globally is for projects that basically involve project finance advisors or MDBs, etc. I think what is harder to capture is corporate investment that happen on existing assets, and that will basically come in the form of like large corporate bonds for which the use of proceeds are unclear. So that tends to be more in sort of secondary market. But within that, we sometimes quite difficult to understand what is investment, what is refinancing. So that's where things are harder to look at. But I think that's why we have this primary market numbers that are basically those projects that we can clearly identify. What we've seen as well in some large markets in particular, or market are fairly open on the energy side, is sort of the proliferation, I guess, of smaller, for example, solar or wind farms. Those are private investments, but they tend to be sort of more commoditized almost. So PPA, sort of template PPA. So if I think at sort of market like India, it's actually quite difficult to sort of follow that. I mean, every year there's like 200 and 300 new power plants coming into play. We have less detail on the financing for those sort of smaller projects. So that's I think the limit of what we can capture. But all in all, I think overall the trend we might be missing a few projects, but that's basically still roughly representing what's happening in markets. So hopefully that addressed that, but yeah, clearly some of them will be PPPs per se. Some of them would be, like I said, privatization, also large project that may not require sort of PPP like structure, but they do require sort of some financing structure that will usually sort of involve consultants and MDBs. That's how those data providers capture that data, right? They work with advisors, they work with MDBs, they work with key investors to try to gather what's happening on the ground. So again, it's it's not just the tip of the iceberg. It's actually probably half to two-thirds of the iceberg if you want. But yes, there's some others where it's harder. We do some work to try to identify that, but that remains a bit of a challenge. So hopefully that addressed that question, but happy to re-clarify again. And because we use primary market, like I say again, is greenfield, brownfield expansion, privatization, and then secondary market is acquisition, what we call additional financing, which usually those sort of corporate bonds, and then refinancing as well. And so all of that is interesting because it gives us a feel for the market, but usually what people are most interested in is the greenfield, what we call primary market, because this is new infrastructure and that tends to sort of address the gap. So now going back, I guess maybe to what you wanted to discuss on the trends. I think, yes, some of them positive, some of them negative. I think one fact remains is that when we compare the level of investment to the needs, we're still very far away from where we should be, right? And obviously going forward, as public investment is being limited by sort of debt issue and interest rate challenges, that remains insufficient. So I think that's where there's sort of like commitment for all the MDBs and other players to try to accelerate that. Again, in terms of like real term numbers, is being stagnant while the needs have actually increased. Population has increased, economies have increased, the need to transition has increased. So again, it's we're far from where we should be. That's for sure. But here we're trying to sort of identify the key positive trends so that we can scale up, I guess, those successes, right? So now moving on to, I guess, the questions around the default rates and how sort of rating agencies are sort of looking at it. So that's in Basel as well. So that's one work that actually GIAB sort of in the G20 has been looking at for quite a few years. There's actually here a big data challenge. So we actually talked to Basel committee and others. One of the challenges that infrastructure is not defined. There's no definition for infrastructure. Hence, it's actually difficult for regulators and global regulators in particular to really understand and have sort of proven track records when it comes to infrastructure assets. Usually that's basically extracted as public finance. A lot of it is infrastructure, but it's not the entirety, right? So as a result of this lack of data, it's actually very difficult for a regulator to sort of go back and basically sort of define infrastructure and sort of define capital charges that will be specific to infrastructure. The insurance industry has sort of moved ahead if you look at the latest guidelines, but when it comes to banks, that's still one of the challenge. Also, when it comes to, for example, the result that I showed in Africa, there's obviously in there the fact that DFI are involved. So that also kind of like make the assessment from the rating agency to be a little bit more complicated. A subset of that challenge, and one that I think is a lot of work being done at the G20 in other working groups as well, is the recognition of de-risking instruments. So currently, when it comes to private, so for governments different, but when it comes to the use of guarantees for private sector, currently the Basel framework doesn't really enable the recognition of this of the positive impact of de-risking instruments on investment. Hence, the difference in terms of capital charges for banks is actually non-existent. So they do have to then go through an actual rating of projects or rating of bonds in order to get rating agencies to recognize that. But even that is actually quite difficult. It's been done on a few occasions. One of the most famous one is an hospital in Turkey, where by mixing up a mega guarantee with a facility from EBRD, they were able to get actually the hospital to be rated 2 notches above the sovereign rating, right? But that requires significant amount of work for rating agencies, and in general, infrastructure debt doesn't tend to be rated, so it's mostly unrated debt. Hence, they fall back onto the sort of typical sort of Basel regulation. So there's still a lot of work to be done on that. But one of the key challenge is really sort of the lack of definition for infrastructure that will be sort of applied across the globe, and therefore the lack of data, therefore the difficulty for rating agencies to sort of move forward on that. Additionally, if I just can add one last point, is we also have to recognize that infrastructure is evolving quite fast, right? Obviously, the long-term risk associated with, let's say, solar or digital is different from the risk that we had, let's say, on a coal-fired plant. So I guess the overarching portfolio of private investment in infrastructure is evolving. Hence, regulator obviously take a conservative view when it comes to, does the past performance really can be applied for the future, right? So I think that'll probably take, I would say, a few years before some of those regulations evolves or sort of being adapted to infrastructure. But that will require, for sure, a lot more work on sort of data, so that the regulators can get more comfortable around those performance metrics. So that leads me to, I think, the third question. So there was a question on green hydrogen. So first, I'm not an expert in green hydrogen, and I know there's a lot of projects that have been announced, including in Africa. I think I think Egypt and South Africa, Egypt and South Africa in particular. But I think there's a bit of reconsideration. I think 2023 was the hype of hydrogen. I think in between there's been a more rationalization of in what cases does hydrogen make sense, right? So there's a lot of work done around. Not sure if you know that the hydrogen ladder that some sort of come up with. So it's kind of like trying to rationalize again when hydrogen makes sense, because obviously for transforming renewable energy into hydrogen, it does work, but there's a lot of sort of energy loss. Hence, it depends if sectors can actually benefit directly from that renewable energy. Then maybe green hydrogen doesn't make that much sense, but in some cases it does, right? So I think what we're seeing across developed markets and emerging markets is there was a lot of announcements in 2023, and in the meantime a lot of cancellation as well of some of those projects. So I think it's again, there's still a lot of appetite. The World Bank is doing some work around maritime, for example, for which green hydrogen seems to be probably one of the solutions. But other sectors, I think the 2023 big boost has sort of like come down a little bit. So I think again, smaller rationalization of markets. When it comes to sort of where in Africa, I think I'll defer to sort of an expert in that topic, on the continent and also on sort of the energy side. But hopefully that gives you an overarching answer. When it comes to guarantees, again here the data is kind of difficult to get. I think the best data set that we mentioned in Monitor in terms of the overarching view is the Bern Union. So the Bern Union is actually, you're talking about ECA, that's basically association of all the ECA, but also sort of private provider of some of those de-risking instruments and MDBs and MIGA, etc. So what we do have is a view of the overarching pool of those de-risking instruments and the size of the deployment of them. But we don't have much data on who is actually providing them and to do what exactly. What we know is that there's a significant gap between what we know and that overarching number. So you can look at, and that's what we've done, sort of look at those sort of blended finance deals, and that's where we sort of had those numbers. Within that is the mix. Some of those instruments are provided by MIGA and some of the MBBs, and some instruments are provided by ECA, and then you also have obviously non-instruments but guarantees provided by the government. Those one can be sometimes difficult because they're not instruments per se, they're just contract terms basically. But that plays a huge role. Obviously, if the government is, guaranteeing payments, that makes a huge difference if that government credit rating is pretty high, right? So that's that. I mean, there's a lot of work that we're trying to do to sort of get better data on that. But what I presented basically cover all of them: the NDBs, the ECA, and to a certain extent government guarantee. Although, like I said, this one is usually sort of more on the contract side. So I'll stop there. But again, there's a whole section in the monitor report where we talk about those different sort of metrics that we have. And also the limitation in data that we currently have, because many of those like ECAs and private sector provider of insurance products, those that commercially sort of sensitive or commercially sensitive data, let's put it this way. Hence, it's actually harder to get a sense of how to use and the terms of those guarantees. So I'll stop there. I think hopefully that answers most of the questions.
Thanks, Henry. That was comprehensive. Let me take Gerard, followed by Veron. Gerard?
Thank you very much, Mr. Miller. Thank you, Henry, and good afternoon and good morning to those in Washington. My name is Gerard van Skalkwijk. I'm from the Strategic Infrastructure Coordination Unit of the Western Cape Department of Infrastructure. One of the challenges we're sitting with is severe weather events. Our 1 in 50-year flood line and our 1 in 100 years have suddenly become every second year. So it's a major challenge that we sit with, especially in the road infrastructure space. So We're busy building digital twins for our infrastructure and then stress testing it against climate change, for example. One of the things that we're running up against is that sometimes the solutions that we seek are not infrastructure in nature, but non-infrastructure, especially ecological infrastructure. I'm just trying to figure out what's the appetite for investment in ecological infrastructure, but when we start looking at it from a systems point of view, the interaction between ecological infrastructure and hardcore infrastructure, and whether or not there sits an appetite within. Thank you so much.
Thanks, Gerrit. Veron?
Hi, colleagues. My name is Veron. I'm from Kapau, GTAC. I also work on the G20 with Henri and Brigham. My question, Henri, is related to your comments that you've made throughout the webinar around, the availability of data being a challenge. And while we're grateful that the GI Hub is making data, these trends available to us to understand, how then do we get governments to make, data that the private sector deems important for forming risk perceptions and, influencing their or supporting the investment decisions available? So how do we bolster private sector investments through the availability of data from the government side instead of, the private sector side? Thank you.
Thanks, Veron. I see Rolf is next.
Thank you, Boitumelo. Let me just switch on my camera as well. My name is Rolf Cantor. I work for Old Mutual. Henri, very interesting presentation. I just have a data question. Is there somewhere a good data source where one can see the evolution of both the ownership of infrastructure projects and the debt financing of infrastructure projects, how that has changed over time from original developers and banks to the institutional investors, sort of long-term investors, including pension funds? Thank you.
Thank you very much. Maybe, Henri, one point that I had here, which I can quickly include is, slide 7 was talking about the risk premium, and when you went to Africa, it's clear that some of the risk premium that we are seeing is actually perceived, and it has to do with unfamiliar markets. So maybe if you could also link or talk about what the market data node is trying to do in relation to, more specifically, in relation to the availability and the accessibility of key data. I think that can sort of add on to the question that Veron was asking. And I'm saying this just so that the colleagues at some point when we bring you back to talk about that specific report, they can try and see what the G20 or what our presidency through the G20 is trying to do to close a little bit of the gap that we are seeing here. Let me maybe just take Lindo. He'll be the last person that we take. Then you can answer all the questions, and after, unfortunately, we're going to have to close. Babkuzwa. Sorry, Hlajwayo. You are muted, my good sir.
Okay, thank you very much, Boitumelo. And thanks, Henri, for the presentation. It is very insightful. My small clarification that I would need, maybe it's a link that I would like you to expand on in terms of the project development and the increase in the infrastructure development, how that is linked versus those that do not have the project development facility to assist in infrastructure development. Thank you.
Sorry, people don't know who you are, Baba.
Oh, sorry.
Yes.
Yes, it's Lindo Hlajwayo from Kapau in GTAC. Thank you.
Thank you very much. And back to you, Henri.
Thanks. All right, so they're all amazing questions. They're all quite complex questions as well. So I'll try to answer, but for a lot of them, I think there's still, like I said, sort of work to be done. So let's start with climate risk. So I think clearly what we've seen by far and large across all type of investors is over the past sort of 2-3 years, way more focus on trying to understand the climate risk around the portfolio. Transition risk, but also pure climate risk. So there's actually one section of the monitor report, the one sort of ESG, that sort of leverage data from both EDEC, so they're looking at unlisted funds, but also GRESB, this sort of working to rate assets. And what you can see is that, again, awareness, definitely work being done on sort of understanding the risk for the portfolio as well. Massive, very significant increase. When it comes to the evaluation of those climate risks on the portfolio, you can see that there's in some of the graphs, you'll see that obviously the increase in capital cost, the direct impact is something that sort of can be very, very significant. I think some of partners at EDEC have done some work on that to sort of value, and that's not in this year monitor. But if you look at last year monitor, you'll see some of the evaluation. So they look at all the assets that enlisted funds had, and they basically try to sort of assess from their perspective the risk, in particular when it comes to increased capital cost, but also increased operational cost. It's a bit harder when it comes to insurance premiums or decreased capacity, but you'll see that's something that more and more investors are sort of trying to assess. So there's quite very interesting data through GRESB on this. The data is a little bit skewed towards developed markets, because that's where investors tend to have like better data and better capacity to evaluate those risks. But we definitely see that as an increased area of focus, regardless of the policy objective of different countries. Investors remain very concerned with those risks and transition risk on the side. So that's on the risk aspect. When it comes to appetite for solutions, I think there's been a lot of interest from all sorts of investors to invest in resilient infrastructure. So I work with previous job, work with cities, kind of cities, and we sort of identify pipeline of projects. There was definitely a lot of appetite from investors to sort of look at that. Some actually created funds. So in Africa, you actually have what's called the Urban Resilient Fund by Meridian and Rockefeller. That was built out of some of the work that we had done under the Resilient Cities Initiative. But I think by far and large, what we found, especially in emerging markets, is that finding bankable projects that can achieve that can be challenging, and so mostly because it's very difficult to recognize the benefits, right? So I think what we see is that there's been some success when the investment in, let's say, nature-based solution or positive infrastructure can actually sort of unlock, let's say, realistic potential. That's relatively feasible, and there's some projects being looked at in the African continent. Again, you can look at some of the project that was called the TURF, the Urban Resilient Fund, is sort of trying to look at. When it comes to sort of looking at other models that could be scaled up, actually PIAF, World Bank PIAF, the trust fund I belong to, we've done some very interesting work that just got released this year, and once I'm not presenting, I'll sort of share it here. It's basically we sort of look at business model or sort of approaches that could actually create opportunities for private investment in sort of nature-based solution and sort of resilient type of asset. So again, I think at this stage we're still looking for models. I think there still need to be a lot of more sort of scaling up of some of those approaches. We're seeing a little bit more if you look at developed market and city environments. You see successful bond raising by some municipalities or regions in order to address some of these issues. But it's a little bit easier to sort of do it almost as a programmatic approach, as opposed to trying to find projects that then need to rely on some kind of revenue revenue stream, which can be quite difficult when it comes to resilience and climate events, right? So that's that. But again, I'll share, or maybe I think one of my colleagues, Manpreet, is online and could share the research that PIAF has just published on the topic, and hopefully there you'll see a lot of examples that could be useful in your context. So that's on, I guess, on climate and solution for this. Now, moving on to, I guess, maybe I'll try to tackle both. What can governments and also what is it that the G20 has done to try to address some of the data gaps that we've talked about. So I think governments can obviously complement, I guess, what the private sector is doing. Private sector data providers are sort of working, like say, with consultants, with MDBs to try to gather all those data sets, and they will remain by far and large, I think, the entry point for global investors. So I think for government, first of all, is trying to sort of not necessarily sort of reinvent the wheel and come up with too many sort of ad hoc type of investors, type of indicators, especially if the objective is to bring some international investor into play. Those international investors will look at benchmarks, right? And if you come up with very good indicators, but only specific to your market, it'd be great. But again, it's going to be very difficult for them to assess whether your market is sort of performing better or sort of less risky than others. So I guess at the very least, the interoperability, which is one of the key recommendations that we worked on this year for the G20, remains very important. I think there's a lot of different platforms that try to assess many risks. They're great, but at the end of the day, investor will go through Refinitiv or will go through Bloomberg to get a sense of the market before they move into it. So that's kind of like at the very high level. Try to basically sort of make sure that whatever data they're using, you actually provide to those data providers. Now, when it comes to, so that's at a very sort of market level. And in there's obviously work that we're doing to try to basically, like I say, streamline a little bit, especially on the banking side, trying to potentially come up with a definition that will be sort of common so that banks can then sort of report on infrastructure performance in a way that will actually be able to be usable by regulators, right? So that's kind of like the work that we're doing this year at the G20. And one of the key recommendations of the market note was actually to sort of bring together central banks, regulators, and banks to try to understand how that could work. Because again, that needs to be sort of global. Basel is a global regulation. And so we'll kind of need to look at how we can do that across the globe in order to get there. So that's at the sort of market level. Then obviously, as governments, investor will first look at the market, and then it will zoom into actual projects, right? And so that's where the quality of data at project level is also very, very important. So there's been some work done by the presidency, the G20 presidency this year as well, as another note that's sort of looking at ways to digitalize or to sort of provide to private investors sort of better data at the project level. And that's obviously a lot of extra work, but that's very critical. And that's something that, again, leveraging existing approaches, existing platform, maybe is sort of the best cost-effective way of doing that. But again, I think most investors will sort of need both. They will need to get a sense of the market, performance in general. They will need to get a sense of the depth of the market as well. Many investors will sort of come in and then look at, an exit strategy, right? They need to make sure that they're not going to be left with an asset that, in an illiquid market, for example. So that's where I think they will look at market, and then they will look at the project specific. And then obviously here, each project will be slightly different. There'll be sort of different risk. But then again, having something that's sort of digitalized, easy to search, will sort of go a long way in making sure that they're comfortable with the project. The other aspect as well is I think South Africa has done a great job in terms of like structuring some of the pipeline, right? So it's kind of in between, right? You get a product level, you get a market level, and in between you get, I guess, a programmatic aspect. So I'm thinking in particular around sort of renewables in the pipeline that's sort of being sort of shared very openly by South Africa. And that is very successful because in a way that sort of it gives a message to investors that A, there is a pipeline, and B, that it's very structured, and that they're not gonna, not not every project will be different. I think investors hate when every project has a different risk profile. It becomes very difficult for them to assess it, very, cost, and it's a lot of burden instead of like re-looking at all the contracts, etc. So I think the programmatic approach from once you have all those projects is very important. That's where we've seen the best success. Again, I talked earlier about India. The fact that the PPAs over there are pretty much template, same thing on the toll road sector, that makes the market, heaven for investors, because they know that each project will be very similar, and that obviously then there will be a secondary market for them to sell those assets, because not every one of them will have a slightly different risk profile. So that goes a long way in attracting, in particular, the secondary market, like the pension funds, etc. That sort of understanding of the programmatic approach and the size of basically a market that's sort of big enough for them to be able to sell that asset if they need to, right? So I think there's probably those three levels. So again, market data, making sure that sort of in line with what global investor will look at, the project level details for and all the specificity that comes within that, but then the middle ground, which is really that sort of programmatic approach that is essential in sort of scaling up that investment and also limiting the cost from you as a government. And I'll come back maybe a little bit on this. I think if you take the case of India, it used to be that every PPE was slightly different. Very interesting, very well thought way of allocating risk, but each project tended to be a little bit too different. As a result, it made it very difficult for investors to come in. So that programmatic approach, I think, is critical. So that leads me to the two last points. So first, the mix of investors. So again, monitor reports. This year we covered that a little bit. I think if you look at last year, you get a better sense of who is investing, and so it really depends on obviously the sectors and the type of investment. We tend to see a lot more sort of bank activity when it comes to primary markets, so greenfield. That's where you see the sort of specialized funds, the Macquarie, the Meridian, the contractors, and usually the financing, the debt financing comes from banks, right? In secondary markets is where you start seeing different type of actors, because again, they're more into sort of long term. They're not usually sort of very comfortable taking a greenfield risk on assets. They're more interested in investing in the infrastructure asset class as opposed to assets. They have no appetite, very few exception, obviously, less appetite to manage asset risk. So I think that's where brownfield assets are way more attractive. So that's where secondary markets, usually when you see sort of like pension funds coming in. So if you look at emerging market, I think to give you some ideas, there's been kind of investment, let's say, by pension funds in, let's say, in Brazil. Usually that's sort of like at the corporate level for like water utilities, a bunch of them. So again, they get access to a portfolio through a corporate. So it's not like a project by project, and they came in once those utilities were up and running. Same thing, India has done a pretty good job of creating a trust fund that basically is investable and basically manage a portfolio of existing toll roads. So again, you limit the greenfield risk, but you're also providing exposure to a portfolio. And that's typically what pension funds and other sort of long-term investors would prefer to invest in. So there's ways to basically, by creating those big corporates or those trust funds, to basically make it more palatable, I guess, to those type of investors. But it's very different, again, primary market to secondary market. So you can look at the last year monitor report, you'll see the evolution of that across different markets. So that leads me, I think, to the last point, which was on project development. So here we're doing actually this year some research. We're trying to get more data on what those project development funds and project preparation facility are doing. It is quite difficult, to be completely frank, because very few project preparation facility reports on how much they spend, success rates, etc. So it's quite difficult to learn and to sort of understand why some of them are more successful than others. What we know is that, yes, if you have development funds that are available and sort of clear willingness from governments to support some of the project preparation, then you do tend to get more private investors, to private investment to come into the country. On the other hand, what we've seen as well is, you know, remember that curve that basically is pretty flat when it comes to private investment in those in emerging markets. We had in previous monitor, last year monitor actually, or no, 2 years ago, we had done the mapping of all the PPF, and it's a very different curve. So basically, number of PPF has exploded over the last 10 years. But we have not seen the impact necessarily on the investments. And so what it tells us is that there's probably like a minimum size required, and it's not something. It's not like it's not magical, right? It's not because you create a project preparation facility that within 1 year you're going to get a lot of bankable project. It takes time. It's a lot of effort. You can certainly look at the Philippines as one of the examples where the government has supported their project preparation units for many years, and now there's a lot of successes, but it requires significant investment and sort of long-term view that we're going to try to keep the capacity as well within a PPF. So in a way, the worst is creating small PPF with a short time to basically do a project. What we've seen is that most of them do not tend to manage to sort of create project. I mean, it takes time, right? That experience, and that's where I think larger regional ones, or one that sort of basically have a longer time to basically run a project and to be more successful. But again, the data is a bit scarce, and that's one of the work that we're doing this year. So I'll stop here, because I think we're about time.
Yes, thanks once again for the comprehensive responses. We have unfortunately reached the time limit that we had, and I want to thank you, Henri. And I saw that Manfred is also online. So thank you, PIAF colleagues, for the comprehensive presentation, but also for the links to the reports, to all the participants. Thank you very much for joining this session. Henri, we've made we'll be approaching you on the market data node, perhaps next month or so, where you can sort of also present on that, because there's a clear linkage between the infrastructure monitor and what we are seeing in the market data node. So Veron will be in touch on that webinar. So thank you, everyone, and happy Nelson Mandela Day, and have a great weekend.
Thank you, everyone. Have a great weekend.
Thank you, everyone.
Thank you,
Thanks.
everybody.
Thank you.
Bye.
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 Thank you.
Thank you. Bye.
Bye.
Thank you.
Thank you. Bye.
Thank you. Bye.
Thank you. Bye.